Well, happy October, everybody. October represents the end of the third quarter of fiscal 2025. We'll go over some of those numbers, but what a spectacular summer and fall it has been so far. I hope all of you have had a chance to get out and enjoy the fine weather that we've been having. October is a very interesting time for us sports fans. We've got playoff baseball that has started. Go Jays, and we've also got the start of the NHL season, and of course, the blessed Thanksgiving and time with our families. So we'll take a couple minutes here and we'll jump to the numbers and review what happened in the third quarter in the markets. Let me just share my screen here with you all. Alrighty, let's take a look at what's been going on. So here we've got a kind of overview of the Canadian market. It has been a strong year up here for the TSX Composite, up 23.2% as of October 3rd. The S&P Total Return Index at 25, the small cap up 37, and the TSX Venture up 61. That has been outperforming our United States counterpart with the S&P 500 up 14.2. We really don't follow the Dow that closely as it's just 30 stocks, but it's up 9.9. The NASDAQ is up 18 and the Russell 2000 up 11. Internationally, it's been strong as well. The world index is up 14%. The EFI index up 24, emerging markets up 24, the United Kingdom up 16, France up just under 10 at 9.5, Germany up 22.5, Japan up 14.7, and the Chinese stock market up just about 16%. But I want to take a little time and talk about the market. And when we talk about the market, there are really 11 subcategories that make up the stock market. So we've got materials, we've got IT, technology, financials, consumer discretionary, utilities, energy, real estate, communication, industrials, consumer staples, and healthcare. And the difference between discretionary and staples, think of needs versus wants. Your consumer staples are more of your needs, where the consumer discretionary, your fun money, if you will, are more of your wants. This is a great tale of what's been happening here in Canada, where the S&P TSX Composite is up 23.2%. But what's really been driving that is the performance of the material space. That space is up 79.2% this year. It represents almost 17% of the Canadian stock market. IT is up 27%, it represents 10%, and financials represent almost 32% of the Canadian marketplace. But if you look at this chart, we've got two sectors, and it was just IT broke into this sector being above the performance of the Canadian stock market because it was up 10% on the week. But materials and IT are outpacing the composite, where financials, consumer discretionary, utilities, energy, real estate, all these other subcategories are underperforming. In fact, healthcare is up just a whopping 0.3% on the year, consumer staples 5.2%, industrials 5.4%. So all of the return in the Canadian market has largely been driven by materials and technology. And the material space in Canada is quite large at 17%, where when you look at the material space in the US stock market, it represents under 2%, a whopping 1.9% of that index. And that space is up 7.8% in the US. The largest sector in the US is obviously 33.5% in IT. Healthcare represents almost 10% compared to virtually nothing in the Canadian market, 0.3%. We don't really have healthcare stocks in Canada. This picture just shows it a little bit better. So of the 25, at this point in time it was 21%, materials represented 9% of that return, financials represented 6.5%, energy represented 2%, technology represented 2%, but consumer discretionary's contribution was 0.5% to the performance of the S&P or the Canadian market. utilities 0.5%, industrials 0.5%. You can see, so by and large, all of the return of the Canadian market this year has come from these two categories. In terms of valuation, the S&P 500 looks a little bit stretched. At the end of September, it was 22.8 times earnings versus the long-term average of 17 times earnings. And we've got a slide in here. Let's talk a little bit about the Canadian market. The Canadian market valuations, again, even though lower at 17 times earnings, are a little bit stretched from what their long-term historic average is, closer to 15 times earnings. We like to spend a little bit of time talking about the concentration in the indices. So when you look at the S&P 500 index, it represents 500 stocks in the US stock market, comprising those 11 subcategories that we talked about earlier. At this point in time, in terms of representation, the top 10 names, the largest stocks, because the S&P 500 is what's called a market weight index. So the larger the company, the larger the weight in the index. The 10 largest stocks in the US stock market now represent 40% of the index and 32.5% of their earnings, which means the other 490 stocks that make up the balance of the index represent less than 60% of that index. So those large behemoths certainly carry a lot of weight in moving the direction of the index. In terms of valuations, again, Mag 7 makes up those top 10, and this year they are up 14%. The S&P 500, if you backed out, the S&P 500 is up 14. The Magnificent 7 is up 18% year to date. So if you took those 7 names out of the US market, it would be up 11%. Often we get asked, well, what are the 10 largest companies? And this just shows you the size of these companies that have grown. If you go back 40 years ago to 1985, $251 billion was the valuation of the 10 largest companies in the S&P 500. They included DuPont, Kodak, Royal Dutch. You got Shell, AT&T, General Motors, GE, Exxon, IBM. However, when we go over here to 2025, 40 years later, we're now talking these 10 names have a valuation of just shy of $20 trillion. JP Morgan, Berkshire Hathaway, Broadcom, Tesla, Meta, which is Facebook, Alphabet, which is Google, Amazon, Microsoft, NVIDIA, the high-flying computer chip manufacturer, and AI, and Apple. So significant value in those 10 names. We're always kind of looking at value versus growth. You can literally put every stock in one of two buckets. It's either a growth stock, or a value stock. Growth has really been in favor and has been the dominant player, hence the performance of the Mag 7. Those are growth stocks. In terms of the valuation of value stocks, they are trading, at a significant discount to what growth stocks are trading at. Value is certainly, trading at a premium to its long-term average at 17 times versus 14 times. But growth stocks are trading at 31 times earnings versus their long-term average of 21 times. Halo, it's not a conversation without tariffs. It's on the news every night. And so this is a really good chart, I think, to kind of give an example and a visual of what's happening in the world of tariffs, particularly south of the border, and how that's impacting us as Canadians. As we know, the Republican Party is in favor of tariffs and believe that that's the best course of action for their country. There's a lot of sentiment that disagrees with that. But on August 8th, the peak of the tariffs was 30%. And by, the end of last month, September 30th, the rate was down to 19.2%. And as you can see, that is a marked increase from the kind of the long-term average for most of the 20th century at kind of 2.5 or 3%. However, when you take in the big picture, the U.S. has taken in this year so far to the end of August, 144 billion in revenue. they've imported 2.3 trillion in imports. And so the effective tariff rate, if you will, on the entire system is 6.2% currently, which is double what it has historically been. This is a really interesting slide, and I think, when we reflect on the performance this year and the volatility, certainly when we turn on the TV at night, we listen to the news, consumer confidence is pretty low right now. But ironically, the market has done well. The economy has stayed reasonably strong. Investor sentiment is still very good. Business sentiment remains strong. And what this historically shows is with lower consumer confidence, you know, we typically get a pretty good move in the market. If you looked at these past points recently, back on August 2011, it moved up 15.5% there. From the lows of April 2020, 43.6%, and even the last kind of bear market back in 2022, up 17% from there. We are in a bull market, and we're coming to October represents the end of the third year of the current bull market. And as this chart indicates, for bull markets in the past 50 years, these are bull markets that have made it past their second birthday. So the longest one was back in March of 2000, lasted 12.3 years. February 20, 11-year bull market. 1987 was a 5-year bull market. 1980, a 6-year bull market. And 2007, a 5-year bull market. And here we are, the red line kind of coming in at the 3-year mark. So if we use history as a guide, it looks like this bull market still has some legs to go. This has been an actually unusual late summer and fall. Historically, we get a little bit more volatility through August into kind of November as the red shaded box increases, over that period of time. This red line is a measure of the volatility in the market. So normally, kind of through the balance of the summer, we've seen a rise in the volatility of the market, correlating with, a bit of a downturn or sideways move in the market, with the latter half of the year, the market settling down, volatility declining, and returns returning. We have not experienced, this period of time. It has remained a very strong market. Maybe it pushes it out farther to the end of this year. It does certainly feel like we're due for a bit of a pullback, a little bit of a sideways move to digest these recent gains in this current year. We've had 3 strong years in the market now. But, when we look at it, I'm kind of getting a lot of questions from clients asking about kind of what does the next leg up look like? And when we look at valuations and stock prices, the number one driver, the biggest mover of the direction of the stock market is a direct correlation to earnings. And as this chart indicates, earnings continue to rise. Valuations seem a bit rich, maybe a little bit expensive, but the forecast for 2026 is that we're still expected to see strong earnings into 2026. And so what we're starting to see in the market is that some of those future earnings, which look robust, which look strong, are starting to be priced into the market now. And just wanted to end as gold has reached $4,000 an ounce for the first time since 1996. We have foreign central banks holding more gold than U.S. Treasuries. I'd like to take a minute and thank everybody for watching. I want you all to know that both Jack and I and the rest of our team, myself, Jack, Joanne, Kathy, and Cynthia, we're here to answer all of your questions. And we wish you all the very best this holiday Thanksgiving long weekend. We hope you get to enjoy time with your family and friends. It's valued time. Make sure you enjoy it. Thank you. We'll talk again soon.